Let's take a closer look at the markets with Sarat Sethi. He is DCLA's managing partner and a CNBC contributor. And Sarat, there are a lot of people who aren't paying a whole lot of attention to the markets these days. They're on vacation, they're in and out. But if you start seeing things like what's happening with the 10-year yield and what that in turn is doing to mortgage prices, it does make people stop, I think, and pause and think, what do I really think about stocks here? What do you think with valuations? What do you think the Fed's going to say at Jackson Hole? How do you kind of put this all together and say, here's what I would do right now?
So I think the rates going up is really important because that's showing the embedded inflation. You guys were just talking about that. And yeah, the front page of the Journal says, you know, maybe salaries aren't going that high, but you look at what UPS just did with their contracts. That's going to flow through the autos, right? They're all going to have their contracts.
Because their contracts are being negotiated.
They are being renegotiated. You've seen the pilots do all that.
40% over 4 years.
Right. And to your point,
Pretty good.
When you start with a high base, you don't have to raise it that much, but you raise it enough that things carry through. So the bond market's telling you that rates are embedded. Real interest rates are actually going up, not just nominal rates, which then affects the consumer over time. To your point about, what are we going to do? Lowe's is talking about, sales coming down 1 or 2% because people.
I think they said 2 to 4%. Comps being down.
Comps being down, and a lot of that was pulled through. So maybe people spend less on their homes now, and that was always the thing. When we're not buying new homes, we'd spend more on our current home. So I think you have to kind of look and say, do I have other alternatives as well? And you can buy bonds, not just treasuries, but you can buy corporates going out 2 to 5 years between 6 and 7%. And you're not talking junk rated bonds either. You're talking about pretty high grade bonds. So you have alternatives. Valuation is going to matter. I know it hasn't really come down to the market yet, but you can look at other stocks. I mean, Lowe's trades at 15 times earnings. There are plenty of other stocks out there. I'm still a stock picker in this market. I think you can buy the J&Js of the world. You can buy Morgan Stanley's. There are a whole bunch of stocks. Uber is cheap at this point. Parent of your company, Comcast, that's doing really well year to date. I think you've got cash flow. So, but this is when you look at your portfolio and say, hey, I can actually have a balance. And, if we were sitting here 2 years ago, you'd say, why would I want to put money into the bond market at all? Or maybe I should just be chasing the Zooms of the world and everything else that's going to grow because nothing else is.
How come the technology stocks did so well yesterday? Usually, as you see yields pick up, that is the thing that stops the high tech.
I think yesterday, if you saw the leader was Nvidia, it was up 8%.
Okay.
Right. So that kind of drove the whole market. Nvidia's earnings are coming, I think, in 24 hours. That, by the way, is going to be huge because the expectations there are so high, right, in terms of where this stock's going to go. And how is that going to flow through to Microsoft? They've all become kind of AI stocks in a sense. So how are we going to do over there? I think the market can be broader. It doesn't mean you don't own these stocks, but you can actually have a lot more opportunity elsewhere. And it gives you that opportunity to get stocks which actually are going to grow. The fear also is when you see yields go up this high is the whole dividend growth strategy, right? Mm-hmm. I don't think you should run away from it because that's where kind of people are saying, hey, I don't need to own J&J because I can get a 5% yield buying a treasury.
Makes no sense to me. The J&J's yield is 2.8%. What do they raise it a year? The dividend, 15% a year.
Yeah.
It's going to be at 5%.
And they're buying back stock.
And it's going to be at 5%. You just do the math on the rule of 72, and the dividend grows into the treasury yield in the time you're owning the treasury. All you do, the best you're going to do with treasuries is maybe beat inflation a little bit.
If you're lucky, and also after tax, It doesn't really work either, right? Because the dividend. So you get, we use J&J.
You don't need CNBC. Yeah. Or Kramer's Investment Club. I mean, there's a reason that people buy stocks. Right. There's a reason you're in that business. But there's a reason Warren Buffett is, got more money than God.
And you use it as part of the diversified portfolio, right?
So you can use it. And insurance companies, pension plans, and elderly, people that need the return of their principal.
So that is the growth and dividend strategy, right? You put the dividend strategy, you put a growth strategy around it. What are some good core companies? You're not going to always get it right, but you diversify. And over time, the key is to beat inflation.
Right.
Because, X dollars, $100 15 years ago is not $100 today.
No.
So you really need that to go up. And even if that is 200 today, it just feels that you need to be in there. So, but what I also find is clients will say, hey, but, my risk is here, but I need to live on this. So you really have to marry those two and say, what can you live with? Because equities don't go straight up.
You have a bunch of fat cats. Are they buying munis now?
Munis are cheap, but I think munis you got to be really careful because you really have to understand the local municipalities.
Then there's the principal risk.
Right.
Not the duration risk, but the actual getting the money back
and
risk.
The money back risk. And you also have to then figure out, because people do move, and if you buy the New Jersey muni and you move to Florida, it doesn't really make much of a difference then at that point. So, again, part of a diversified portfolio, but I think you get better bang for your buck in certain corporates, and also buy some of these stocks that people just think, hey, why do I need a dividend growth strategy? Or, I just want to buy everything that goes up 15%.
Did you see the Nick Timmeros story about, are we looking at much higher interest rates, basically never going back to where we were? You guys must have talked about this yesterday.
My entire career was 8 and 7%.
Yeah.
Jimmy Rogers, but said we'd never see below 6% on a treasury ever,
right.
ever. Would have bet his entire fortune on never. And now we're stuck. We think 4.3% is high on a 10-year.
And it's funny, right? We always kind of say you get this recency bias, right? I mean, 2 years ago, I'll go back to that again. We're like, rates are never going to go up. There's no way we're going to be at 4% again, right? So I think nobody knows the future, but you predict. What you do is you diversify again, and you say, hey, listen, if rates do come down, I want to be in growth stocks as well, because that's where everything is.